Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap here where we go over all of the trades that we made today on the membership side of our website. So remember, these videos go out every night to our members after we make trades. We go over all of the trades we've made, both opening orders and closing orders in detail. But if you're watching this on YouTube, you have to understand that you're getting this video publicly about 5 to 7 days after it goes out to just members. So you can't take advantage of these trades without signing up for a membership at OptionAlpha.com. Now, for those of you who are members, I want to point out one feature that we've had in the membership real quickly before we get into tonight's tutorial. But I want to point out the video tutorials for archived members videos. So again, if you just go to our website at OptionAlpha.com and click on the members homepage, from there you'll go to the video tutorials section, where we have a ton of different categorized video tutorials, from options trading basics to bullish strategies, bear strategies, neutral strategies, everything out. But under the archived members videos, which is right below here, you'll see in the top left-hand corner, if my mouse would slow down with me, a playlist up in the top left-hand corner. So this playlist then shows you all of the videos that we've uploaded here over the last couple months. And so it's all archived right here for you. And all you gotta do is just scroll all the way to the bottom and you see the most recent video. So all of the videos that we've done, even if they are within the last 7 days, they're not available publicly on YouTube, but they are always here available for you in your Option Alpha membership. So that's a great resource going forward for you to go back and check out some of those videos we've done. All right, so let's go forward and take a look at what we've done here today as far as trades that we've made. So we had a lot of opening trades because obviously implied volatility has been really, really favorable, but also some closing trades. So we've taken off some trades at a profit and we want to go over those. Now last night we only had one trade, so instead of doing a whole long spiel and video and recording it and getting it up for one trade, I just decided to throw this USO trade into tonight's video as well because we had a lot more to trade today. So we did actually get out of our vertical call spread in USO, and that was the February 33.35 call spread. We were in it for about $1.05 and we exited for $1.38, made about $33 in profit per spread. So again, we bought back or sold for those spreads. So it was a very nice profitable trade, made a couple $100 on that trade. Again, with all of these vertical spreads that we're trading, just debit spreads, we're trading these with a 50-50 probability. So if I actually go to the chart of USO, when we actually traded it back down here near the lows, all we were saying is that we wanted USO to increase in value anytime between now and expiration. And so since it did that, since it made that nice upward move that we were looking for, we got to take profit off the table. It's a 50-50 bet when we made the trade. So we have to take money off the table and start tilting those odds in our favor. And that's, again, what you have to do with these trades. You got to take them off. The two other ones that we got rid of today were the vertical call spread in J&J and also the vertical call spread in F, which is Ford. So in Johnson & Johnson, we had the 95.5, 95, or 92.5, 95 call spread. Got rid of that for a 33-cent debit. Made $32 per spread on that. Nice little profit. Made about half the total premium that we could make. So we are practicing what we're preaching. On Ford, same thing with Ford. We got rid of it at almost half, or a little bit over half of what we could potentially make on the deal. We entered that with a nice profit or spread premium of 35 cents. Got rid of it at 10 cents on the 16-17 calls. And obviously the market continues to fall down. So we're going to take some of these call positions that we've been putting on over the last couple weeks. We're going to take those off and start gearing up and tilting our portfolio more towards the bullish side as the market continues to, kind of drift lower here, and position ourselves for a little bit more of a move in that direction. So that's what we try to do here. Have trades on both sides of the market. As the market starts to fall, we take some of these call spreads off. As the market rallies back up, we'll start adding more call premium and then also taking off some of the put spreads that we've been adding the last couple weeks. So let's go over some of the opening trades that we made here today. I'll start off with the vertical call spread that we had in HD, which is Home Depot. So we sold the 82.5 call spread and took in a premium of $53 per spread. So again, that means we sold the 80, bought the 82.5. The net difference in price was $53 per spread. So if we actually go to Home Depot and take a look at why we entered this vertical call spread, why didn't we just buy an option? And that's really because implied volatility is, again, above that 50th percentile that we look for. Now, Home Depot has had a huge sell-off. So usually we would actually try to take the opposite side of this trade. And that's typically what we do in a lot of our videos is if it has a huge sell-off, we try to play the opposite side of the market, look for a little bit of a bounce, a little bit more of that market cyclicality. But since we already have so many other put positions, meaning put vertical spreads below the market, waiting for the bounce in the market and all of these stocks that we're trading, I felt prudent enough that we could actually sell a call spread. Again, you're selling it with the same probability of expiring in the money, so your probabilities aren't changing, but you're actually just flipping which direction in the market you're trading. And by selling this call spread, then we start to even out our deltas, and that's really what we want to get to here. We started taking off trades as we saw tonight in the video. We take off some of the call spreads that are profitable. That means that we don't want to have all put spreads. We don't want to be 100% tilted to the bearish side of or the bullish side of the market. So by taking off some of those call spreads, we also want to add some new call spreads, add some new premium into our portfolio and be a little bit more balanced. So that's what we're doing here. Again, we would typically trade the other side of this market, but right now we have so many put spreads that we put on. We want to enter some call spreads and kind of even out our deltas. The next position that we got into today was a vertical call spread on OIH, and this is really kind of going back to what we got out of in USO. So we got out of the call spread and thought that the market would go down for oil. It did, or got back out of that. So now OIH has gone down, so we actually think the market's going to continue back up. We bought the 44 calls, sold the 46 calls to help finance the purchase of the 44s, paid a total debit of $1.10, a little bit over mid-price. Again, mid-price for this kind of trade, it's a 50-50 bet since it's a debit call spread, is around $1 in premium, but that's okay. We want OIH to trade anywhere above 45 between now and March expiration. So you can see that we've given ourselves a lot of time. It's got to trade just anywhere above 45, which is right about here. Anywhere above 45 between now and March expiration, which is all the way out here, this red dotted line on our chart. I think it gives us a great opportunity to make a 50-50 bet, at least to the bullish side of the market, which is what we're trying to do. Start tilting some of these trades bullish. The next one that we entered was a vertical put spread in Apple. This one's a little bit different. Again, adding some negative delta to the portfolio since we have so much positive delta and put spreads in there. But we bought the Apple March 505 puts and sold the 500 puts. Paid a debit of $270 per spread on that. Again, a little bit over mid-price. The difference between the strikes is $5, so we usually like to pay half of that, or $250 in this case. We paid $270. That's okay. It's a little bit over mid-price. Not too shabby. Apple's actually had not a really good run here recently, and so what we're doing here is playing downside of the market here in Apple after earnings, possibly wanting this stock to continue to gap lower after earnings. So sometimes when the stock gaps low like this after earnings, it will continue to fall. So that's what we're doing. We're seeing if Apple's going to fall, adding some negative delta to the portfolio. We could definitely see Apple continue to run. Implied volatility super low right now. You can see on this bottom chart of implied volatility, it's at the 12th percentile, so it's nowhere near where we would need it to be to sell a call spread or sell a put spread or any type of option selling strategy. So in this case, all you can really do are make directional assumptions or trade some calendars in some cases, but it's really not even a good time to trade calendars. All right, and then let's get into two of the other trades that we made. Two of the bigger ones. The one big trade that we made here, which was a little bit different, is this butterfly in XOM. Now or XOP. So we've actually traded XOP a couple times before in the membership. Been really profitable for us as a ETF, and we decided to go with a very even spaced neutral butterfly here. So we actually ended up selling the 63s, buying 2 of the 66, and selling 1 of the 69. And so by doing that, we actually end up with a debit of $64 that we paid out. But here's the thing. We want this stock to trade and focus right around the mid price of 66. Now we have a little bit of leeway on each side. So we can go down to about 64 and we can go up to about 68 as far as price. So that's really our range, is about 64 to 68, focused really hard and centered on 66. That's where we want XOP to trade and close by March expiration. So what does that visually look like on the charts? Well, here's a chart of XOP, and you'll notice that implied volatility, again down here by this graph, which I've also thrown up here, has really popped here in the last couple days and is now over that 50th percentile that we talk about. It's at the 55th percentile. And by basing our trade right at 66, which is about even with where the stock closed at today, what we did is bracketed the market between about 68 and 64 between now and March expiration. So the stock can trade anywhere between this range. And as long as implied volatility goes down, the stock continues to stay in that small range, we should make a very, very healthy profit at expiration. If it trades outside of this range, obviously, then that's not where we want it to be, but we want to add some market neutral direction to our portfolio. This is a very delta neutral trade, and you can see that this stock, except for this one period back in September and August, actually trades fairly calm. It doesn't have too many sporadic movements, so we could definitely see this thing go all the way to expiration and stay right around 66, which would be ideal. But that's a butterfly trade that we put on here today. All right, so let's talk about this RUT. So with RUT, this was actually a leg into an iron condor. Now, a lot of people, when they trade iron condors, get really concerned about legging. They don't like to leg in. They don't like to add the put side or add the call side separately. And I showed you guys this today because it actually was a lot better for pricing, and it was a lot quicker to get filled by separating these two orders out into the put side and the call side, as opposed to entering them as one big fat order. So when you enter them as one big fat order, you got to find another options buyer who wants to take on that iron condor at exactly those strikes, at exactly that credit, at exactly the same time. And it's really hard to do. So sometimes what I advocate is take your iron condor and spread it out and break it up into two pieces and leg into that position. So that's exactly what we did today. Earlier in the day, we actually sold the vertical put spread, the 1,950 put spread. Again, very wide in premium, but we took in a nice credit of 267. We came back later on at the end of the day and sold the call spread, the 1,200, 1,250 call spread. Again, took in a nice premium of about $3. So very close to our premium on each side of the market, on the put side and the call side. And you'll notice that at the end of the day, by selling the call spread at exactly the same width, at exactly the same number of vertical spreads, we did not add any additional premium to the overall strategy. So all we did was add additional credit. What that does is move out our break-even points, gives us a little bit more breathing room. And really, this is a very wide iron condor on the RUT. So let's actually go to RUT. We'll take a look at exactly where these premiums came up at. So let's go to RUT, and you'll notice that I actually dropped down here. I'm doing this in my SEP IRA account. So this is an IRA trade for me. Very easy to do this in your IRA. It doesn't have to be this big, massive strangle or straddle. You can do these wide iron condors and still take in a lot of premium. So you'll notice, again, down here in the bottom left-hand corner, we have our two positions, the two separate verticals that we entered, the 1,000 put, 950 put, and the 1,200 call, 1,250 call. But where did we enter that trade? So where was the actual pricing and probabilities? Well, let's go to the actual pricing tab, and you'll see our position here on the right-hand side. And it's designated by these little tags here, this POS or position for the sell side and POS position for the call side. And you'll notice on the put side of the market that our probability is right at 13.43%. So we're trading about 10 to 15% probability on one side of the trade. And then what we did is we went back up to the call side and looked for that same probability on our first strike. So our first strike here was 1,000, and we looked for the call side to be around that same type of probability. And you'll notice that on the call side, the first strike is 1,200, and we're trading about the 12 to 15% probability range. So what that means is that if we add these two probabilities together, we get about 30%, give or take, depending on when you entered the orders. We get about 30% probability that we're going to lose on this trade, or about a 70% chance of success. So this is a very, very nice wide iron condor. Gives us a lot of room, lots of premium for time decay and expiration and volatility to contract. And that's what we want, especially in my SEP IRA that I have. I want these nice, big, wide kind of positions that you don't even really have to manage all the way through expiration, because you've done what you've done in risk entry as far as managing the position with one trade. So that was a good example of how to leg into an Iron Condor today, and definitely trading Iron Condors in your retirement accounts as a really good way to add some risk and some juice to your retirement returns. So as always, I hope you guys enjoy these videos. That's all the trades we made for today. Please add your comments below if you have any questions about anything we made today. Share these videos on YouTube, Facebook, Twitter, etc. Help spread the word about what we're doing here at OptionAlpha.com, and we'll see you guys tomorrow.